A few weeks ago, the Reserve Bank of India came out with an important circular, or should I call it a clarification, to banks saying that non bank prepaid instruments could not load credit lines. A lot was said that the likes of Slice, Uni would be impacted. But the companies continued to onboard customers because they had relations, like, for example, with the State Bank of Mauritius. Having said that, Slice has now written to all of its customers saying it's going to stop credit lines, which basically means there will be no revolving credit. Instead, it will be looking at each loan afresh. Slice, Uni, etc., have been helping bring first time borrowers into the financial system. To talk more about this, joining us is Vaibhav Kakkar from Saraf Partners. Hi Vaibhav, good to have you on the show. I'm sure you've seen the communication which has been sent by Slice to all of its consumers. What did you make of it? So no more revolving credit. Each time a Slice consumer will want a loan, it'll be seen as what? A fresh application?
Yeah. Hi, Nayantara. Pleasure to be interviewed here. Yes, I think, if since I've carefully looked at what the product seems to be suggesting, it is going to be in the nature of a term loan each time a customer transacts at the relevant merchant POS. There will be, I think, they've obviously got some great back-end tech solutions at play, which will ensure that the loan gets processed almost immediately and instantaneously. And through that sort of a loan facility, the customer will be able to then utilize the money for the purposes of purchasing the relevant product.
And now what it is suggesting to do and what it has written to its consumers, and if you were to juxtapose it with the RBI clarification, does it fit with the clarification? Is it now in confines of that clarification? Is it doing what the RBI thinks fintechs should be doing?
I think, to go back, that's a very fair question to ask. I think if you were to look back at the nature of the clarification, I think many of us as practitioners, who've been heavily advising in the fintech sector would say that the RBI clarification was an overreach. It was trying to sort of bring in a new rule, which was never there. The PPI wallet guidelines nowhere stipulate that my wallet or Nayantara, your wallet can only be funded by you. It could have been funded by third-party sources as well. And so therefore, to that extent, when that clarification came in, obviously, it sort of disrupted a lot of innovation that is taking place at the moment in the very exciting Indian fintech sector. What Slice has attempted to do and what some of the others are also trying to do is to obviously try and innovate, try and understand what RBI's concerns are and try and proactively address them. If you were to look at what's happening here, Nayantara, there is a regulated entity which is issuing a PPI wallet. There is also a regulated non-banking financial company that is permitted by RBI to extend loans. And what this innovative fintech companies are doing, and without sort of being specific to one name, and is the fact that they're tying up the two. They're tying up a regulated NBFC. They're tying up a regulated PPI wallet of a bank. And they're connecting the two dots and saying, let me come up with a tech stack which enables each time a customer goes to a particular POS of a merchant, whenever he or she transacts, the NBFC does a quick check bases all the details that they have, all the data that they have, and then be able to offer a term loan to the relevant customer. So RBI in the past, Nayantara, had one of their biggest concerns was that this whole product or the earlier version of the product was very much akin to a credit card. They were particularly concerned about revolving credit because that feature made it almost resemble a credit card. And for various policy reasons, RBI has a very strong view that banks, know to regulate themselves much better. Quite ironically, you look at the last 5 years, more banks have been busted than NBFCs. But they've, on that backdrop, they've always taken a policy position that that banks would be permitted to issue credit cards. So therefore, they had this concern. I think if you look at this new version of product, I think it does address to a very large extent some of those concerns. Although I again emphasize, I do not believe any of these concerns have a legal basis. But of course, RBI as a regulator has certain policy objectives. And from that standpoint also, two regulated entities, the bank, which is a wallet issuer, as well as the non-banking financial company, which is issuing loan, Both are being regulated here. Proper KYCs are being done. And on the basis of that, loan is being given to the individual customer with no revolving credit. So that solves for the perception that these were disguised credit cards. And hopefully, RBI should be able to appreciate that no arbitrage is taking place, and it is only enabling extension of more credit in the sector here right now, and serving really the underserved. Those cab drivers, those delivery boys who are unable to get credit from bank are able to then utilize these innovative products to be able to then go about doing whatever purchases that they wish to. So I think it's an overall great innovation that the company has done, all for it. And I genuinely do believe that the underlying concern of the RBI was not found on very strong legal merit. And certainly with these tweaks, I don't think that concern should exist at all.
I'm going to play devil's advocate here, and I know the last time you were here on the channel, you snubbed me for playing devil's advocate, but here, nevertheless, what RBI wants is what? That there should be no regulatory arbitrage. That if you have banks, if you have NBFCs that have to follow all kinds of rules, all kind of procedures, including which, fintech should also be doing full KYC, then why should a new breed of companies be outside of the regulation and play on the regulatory arbitrage?
No, I think it's a fair question, and I'm all for you being a devil's advocate, Nayantara. That's what we do for a profession, to be able to debate and talk through various legal points as long as there's a merit to it. I think the short point here is what we were trying to explain, and what I was trying to explain just now as well. There is no arbitrage. If the loan extension is happening from a licensed NBFC, and if there is wallet that is being operated by a regulated issuer such as a bank, then where is the arbitrage? The arbitrage could only be where the KYC guidelines were being short-circuited, where certain extension of credit was being given on a basis which somebody could have argued it is nothing but a credit card, because there the RBI policy is that only banks will be permitted to issue. None of that is happening here. The product that they're offering is distinct from what a credit card seems to offer. And as long as you are tying up with regulated entities, I don't see any scope of regulatory arbitrage. Both actions of bank and the NBFC are subject to RBI audit and inspection. I'm all for iterations and progressive regulations. And if RBI therefore believes in models like these, there needs to be stronger checks and balances, limits on ticket size of these loans that are being offered, or maybe even stronger KYC, subsequent verification. I think the industry would largely welcome regulation. The problem comes, Nayantara, where overnight, RBI comes out with these kind of clarifications, which are really not, come to think of it, clarifications. They're a change in law and disrupts existing businesses practices. I think no investor, no business really likes disruption where the rules of the game change midway. Everybody is all for incremental, regulation, and improvement on that account is always welcome. It's the shutting down which is a challenge.
Investors will obviously always want policy continuity. I take that point. Startups want to be the ones who disrupt, not be on the receiving end of the disruption, whether it's regulatory or competitive. I take all of those points. However, what about the consumer? Because, at the end of the day, there are now reports and data out there which suggest that since the June clarification of the Reserve Bank of India, new customer acquisition has fallen to almost 1/10 of what it used to be. What about customers?
No, you're absolutely right. I think the biggest loser in all of this U-turns that has happened by the regulator is the biggest victim in all of this is customers. Genuinely speaking, if you look at why fintech in India is doing well, why globally fintech is doing very well, because banks have not gone about doing their job of credit extension in a good way. And so there is a highly, enhanced amount of underserving of credit that has happened even in urban areas. You go below an income level, and you will see how difficult it is for them to get loans. So these sorts of, why were these products doing so well? Because there was an absolute need for it in the market, and there were a lot of consumers which were taking up that. In this entire move that the RBI did, it's the consumers who've lost out. And therefore, now when the companies are coming up with newer products, newer methodologies to be able to address RBI's concerns, I think we should all welcome it with open arms. And wherever the regulator believes, and again I will repeat myself, wherever the regulator believes there's a scope for abuse, by all means consult the industry. You have a fintech department. Their job is to promote and encourage fintech sector as a whole. And please, by all means, consult with stakeholders, incrementally improve regulations, bring in more checks. If there are concerns on extortionist practices on recovery, by all means, you can have detailed guidelines and ensure and do regular periodic checks. But insofar as this overall process is concerned, I think we should all support it. And you're absolutely right. It was the consumer that was being affected. And with these sorts of new innovations, we should be welcoming it. That's the only way the credit extension and credit distribution in this country will improve. We have an abysmally poor credit delivery on ground level. That has to improve. And that has been the global trend as well. In the US also, banks lost out that battle to the fintech companies. We are seeing something similar happen here. RBI does, for understandable reasons, have a little bit of regulatory bias towards banks. That mindset has to change. Only then, when on ground the regulators start, promoting fintech, will they actually really truly deliver in spirit the speech that the RBI governor had given, that fintech is the way the India's economic growth and credit delivery will take place from here and after.
Okay, Vaibhav. Thanks again for joining us here on ET Now. We've, of course, seen the likes of Jupiter, which stopped their products from day one of that clarification which came in. Others continued. You've seen a drop in consumers. And here's Slice, which is now flipping its product just to make sure that it is, of course, within the four walls of the clarification that has been issued.
Thank you so much. It's a pleasure.